Hey everyone, Shannon Johnson here with Journey Home Realty with this month's market update. We have a lot to cover in this series, so please forgive me. I'm going to use my notes so I can guide our conversation and let you know what's going on. First and foremost, I think it's so important that we talk about rates, right? Everybody's got questions about our mortgage rates. So what determines the mortgage rate? Well, the mortgage rate is determined by the spread between the mortgage rate and the 10-year Treasury yield. And historically, it is 1.7, but today what it's sitting at is 2.89, and that was as of the 1st of March. So that is what is causing our mortgage rates to be where they are today, as opposed to, unfortunately, what you saw when we were historically low, right? But right now we're getting there to our historical norm, but we're just not quite there yet. So what drove this in 2023? It was inflation expectations. So what happens is the higher the rate of the inflation, the higher the yield, because investors are demanding to be compensated for this inflation risk. And inflation hasn't come down just yet because the feds are cautious. So in this graph right here, you're going to see the CPI, the Consumer Price Index, which shows our inflation. And you'll see in the 70s, the feds came down too early, and then the inflation skyrocketed again. So economists believe that they are using this tool to ease that because they don't want to drive us down too fast, which would turn around and drive us all the way back up. And in this next graph, you will see here that the feds are working, and we see that because you can see how it's like bobbled a little bit. As they've started to ease us down, we kind of bounce around a bit. 2% is where we want to be. That is considered the sweet spot. That's that target percentage that they want us to be at. You see the CPI has been bouncing around as the feds try to stabilize the economy. So in this next graph, you're going to see where our CPI is starting to come down, and you will see that the feds are working to ease us down and bring the prices down. The 2% is our target percentage, right? And you see how the line is bouncing a bit. So the CPI has been bouncing around as the feds try to stabilize the economy. The great news is that inflation is coming down, right? We see it trending in a downward rate. So what does that mean for mortgage rates? Like, what's our outlook? Okay. In this next graph, you're going to see that the Fannie Mae projections in December versus today, they are still anticipating that we will see the high fives in the fourth quarter. Now, I know that originally we thought it would be like the low fives, but I think high fives is where they're anticipating that we'll end up. So the economy, where it stands, plays a huge role in that, right? In the mortgage rates. All right, so let's talk about the economy and where it stands and how it plays a huge role in the mortgage rates today. So economists were polled in January of 2023, and they were asked, what is your outlook on if you anticipate a recession? And 39% of them said that they foresaw us having a recession in 2023. The same group of economists were polled in January of 2024, and they said that 61% of them do not anticipate a recession now, which is great news. And we're seeing that across the board. Unemployment rates were below 5%, and they anticipate that they will stay that way consistently for the next 3 years. And also, let's talk foreclosures, right? So foreclosure metrics year over year have gone down 2.2%. We did see a small uptick in the last 2 years, but since then we've considered to trend down. And this next graph, I'm going to show you that. But there has been over 1 million fewer foreclosures in the last 5 years. And why are we seeing that? Well, one, the market is continuing to stabilize to help with that. And then also the huge reason that we are seeing foreclosures come down so low is because homeowners have such a high amount of equity And some people would say they are equity rich in their homes right now, right? Most Americans who are in good standing have a tremendous amount of equity that even if they were in a financial crisis, they have the ability to sell their home and get out from underneath it with money to pay off that debt and walk away with money in their pocket. All right, so let's chat about home prices. In this next graph, I'm going to show you, you will see that we've had over 1 million fewer foreclosures. And why do you think that is? It's because Americans right now are considered, or homeowners right now are considered equity rich. So even when we found that homeowners were in a financial crisis, unfortunately, they were able to sell their home and get out from underneath that loan without having to foreclose on it, which is huge. So that wraps up this portion of our market update. So we will end here and we'll pick up in the next session where I'm going to talk about home prices and home appreciation and what we anticipate over the next 4 years. All right, catch you in the next one.